Investment Valuation: Tools and Techniques for Determining the Value of Any Asset by Aswath Damodaran. Have you ever stood before something, a house, a piece of art, a vintage car, and wondered what it was truly worth? Not just the price tag hanging on it, but its real, intrinsic value. It's one of the great mysteries of life, really. And in the world of finance, it's everything. Picture this, the late 1990s. The internet was bursting onto the scene like a rock star crashing through a wall. Companies with names that sounded like rejected science fiction characters were popping up overnight. They had no profits, sometimes no actual products, but somehow their stock prices were launching into orbit like SpaceX rockets. Dot-coms, they called them. Suddenly, everyone was a financial genius, and money was raining from the sky. Analysts, the supposed experts, weren't just recommending these stocks. They were practically doing cartwheels in their pinstripe suits, promising a magical new world where quaint old ideas like profit and value were about as relevant as a fax machine. And then, boom, the bubble popped in 2001, and fortunes evaporated faster than water in the desert. The anguished cries of investors echoed through the marble halls of Congress and the cramped cubicles of Wall Street. It was a brutal, expensive reminder of a truth that every generation seems determined to learn the hard way. Price is not the same as value. Oscar Wilde nailed it when he said a cynic is someone who knows the price of everything and the value of nothing. That market crash taught us that in investing, being a cynic is like playing Russian roulette with your retirement fund. But what if someone had written a map through this minefield, a guidebook for navigating the treacherous waters between price and value? Well, good news, someone did. It's called Investment Valuation, and it was written by a man who has devoted his entire career to answering one question: what is anything really worth? Meet Professor Aswath Damodaran. Professor Damodaran is something of a legend in finance circles, the kind of teacher who can make compound interest sound as exciting as a thriller novel. He's a finance professor at New York University, but he's not your stereotypical academic gathering dust in an ivory tower. He's a translator, someone with the rare gift of making the impossibly complex feel surprisingly simple. For decades, he's been the secret weapon for Wall Street professionals, MBA students, and curious investors around the globe. His work has sold hundreds of thousands of copies and been translated into languages you've probably never heard of, becoming the definitive Bible of valuation. And today, we're cracking open that Bible together. Here's my promise. By the time we're done, you'll understand the fundamental secret that separates Wall Street's shrewdest investors from everyone else, desperately checking their stock apps at 3 in the morning. You'll discover that valuation isn't some mysterious dark art practiced by people who speak only in acronyms. It's a craft, and it's one you can actually learn. We won't just list chapters like a grocery list. We're going to weave the core wisdom of this book into a single, compelling story. Think of it as the quest for true value. So grab your favorite beverage, get comfortable, and let's dive in. Let's kick things off with a simple idea that sounds almost too obvious to mention. An investor should never pay more for an asset than it's worth. I know. It sounds like saying water is wet. But here's the thing. People forget this constantly. They get swept up in the excitement, the momentum, the fear of missing out, and suddenly they're buying things at prices that would make a casino look like a sound investment strategy. They fall into what's called the bigger fool theory. The thinking goes like this. Sure, I'm overpaying, but I'll find someone even more foolish to sell it to at an even higher price. And sometimes, for a beautiful, intoxicating moment, that actually works. But it's basically financial musical chairs. And when the music stops, someone's left standing there, holding an empty bag and wondering what happened to their life savings. Real value, the kind that actually endures past the next news cycle, has to be grounded in something solid. When we buy a financial asset like a stock, we're not buying it because it looks pretty in our portfolio, or because it makes us feel like a Wall Street hotshot. We're buying it for one reason: the cash it's expected to generate in the future. That's it. Everything else is just confetti. The price you pay for any asset must reflect the cash flows you expect to receive from it. This is the bedrock upon which all of valuation is built. Now, before we venture any further into this territory, we need to clear away a few myths that fog up our thinking like a bathroom mirror after a hot shower. The first myth is that because valuation involves numbers and equations, it must be completely objective and scientific. This couldn't be further from the truth. Yes, the models are quantitative, but here's the dirty little secret. The inputs, the stories we tell ourselves about a company's future, are entirely subjective. In fact, the biggest trap in valuation is that we often have a price in our heads before we even start crunching numbers. We're biased. We want a particular outcome, and so we unconsciously twist the numbers to match our narrative, like a defense attorney building a case. The best analysts, the truly wise investors, know this about themselves. They acknowledge their biases and wrestle with them like Jacob wrestling the angel. The second myth is that a good valuation is eternal, carved in stone like the Ten Commandments. Wrong. A valuation is a snapshot, a Polaroid of a specific moment in time. It's based on what you know today, but the world doesn't stand still. New information floods in every second about the company, its competitors, technological disruptions, economic shifts. When the facts change, as the great economist John Maynard Keynes supposedly said, you must change your mind. That valuation you sweated over last week, it might already be obsolete. The third myth is that a proper valuation gives you a precise estimate of value, like measuring the weight of an apple. The future is uncertain, wildly, unpredictably uncertain. Our estimates of cash flows and risk will always contain errors. The goal isn't to arrive at a single perfect number that you can frame and hang on your wall. It's to arrive at a reasonable range of values. The less information you have, the wider that range needs to be. Valuing a mature, stable company like Coca-Cola is like measuring the distance to your mailbox. Valuing a young, volatile tech startup is like estimating the number of stars in the galaxy. But that doesn't make valuation useless for the startup. Quite the opposite. That's where it's most valuable, because it forces you to confront the uncertainty head-on, rather than pretending it doesn't exist. So how do we actually begin this quest for value? There are three main approaches, three different philosophies for uncovering what an asset is truly worth. The first approach is discounted cash flow valuation, or DCF for short. This is the foundation, the bedrock, the granite upon which everything else is built. The logic is beautifully simple. The value of any asset is the present value of all the future cash flows you expect to receive from it, brought back to today's dollars at a rate that reflects how risky those cash flows are. Imagine you're buying an apple orchard. What are you really paying for? The dirt? The trees? The charming wooden fence? No. You're paying for all the apples you're going to harvest and sell year after year. DCF valuation is just a more systematic, disciplined way of thinking about that. We forecast a company's cash flows, the actual cash left over after all expenses and reinvestments, and then we discount them back to figure out what they're worth in today's money. The higher the cash flows, the higher the value. The riskier those cash flows are, the more we discount them, and the lower the value becomes. There are a couple of ways to slice this. We can value just the equity stake in the business, which means looking at the cash flows left for stockholders after everyone else, bondholders, lenders, that annoying creditor from accounts payable has been paid. Or we can value the entire firm, equity and debt together, by examining the total cash flows the business generates before any debt payments. Both approaches, when done correctly with consistent assumptions, should lead you to the same conclusion about what the equity is worth. It's like reaching the summit of a mountain from different trails. This approach is powerful because it forces you to grapple with the fundamentals of a business. What actually drives its growth? What keeps the CEO awake at night worrying? How profitable is this thing really? You can't hide from these questions in a DCF valuation, but it has its challenges. It can be tricky for companies in financial trouble, for cyclical firms whose fortunes rise and fall with the economy like a roller coaster, or for young companies with no track record and earnings that are deeply negative. But difficult doesn't mean impossible. It just means we need to be more creative and flexible, like jazz musicians improvising. The second approach is relative valuation. This is how most people actually value things in real life. Instead of trying to calculate intrinsic value from scratch, like you're building the pyramids, you look at what similar assets are selling for in the market. You price a house by comparing it to other houses in the neighborhood. You figure out what your used car is worth by checking what similar models are going for on the internet. In the stock market, we do this using multiples. The most famous is the price-to-earnings ratio, or PE ratio. You take a company's stock price and divide it by its earnings per share. Then you compare that ratio to competitors, or to the industry average. If a company has a PE of 15 and the industry average is 25, the knee-jerk conclusion is that the company might be undervalued, a potential bargain. There are other multiples too. Price to book value, price to sales, price to the number of users, whatever metric makes sense for the industry. The appeal is obvious. It's quick, it's relatively easy, and it feels intuitive. But here's the catch. It's also incredibly easy to misuse. The key challenge is finding firms that are truly comparable. And here's the uncomfortable truth. No two firms are exactly alike. They have different growth trajectories, different risk profiles, different profit margins, different management quality. A naive comparison of multiples without adjusting for these differences is like comparing apples to oranges while pretending they're both apples. For example, a high-growth, low-risk company should naturally trade at a higher PE ratio than a low-growth, high-risk company. If you just compare their PE ratios directly without context, you might conclude the high-growth company is expensive when it's actually fairly priced, or even a steal. The secret to using relative valuation well is understanding the fundamental drivers behind the multiples. And where do you learn those drivers? From DCF valuation. The two approaches are like dance partners. They work best together. Good relative valuation isn't lazy comparison shopping. It's a disciplined hunt for assets that are mispriced relative to their fundamental characteristics. The third approach is a bit more exotic and revolutionary. It's called contingent claim valuation, and it uses option pricing models to value assets that have option-like characteristics. Now, what does that actually mean in English? An option gives you the right, but not the obligation, to do something at a certain price. A call option gives you the right to buy something. A put option gives you the right to sell it. Many assets have these characteristics baked into them, even if you don't immediately see it. Think about a patent owned by a pharmaceutical company. That patent gives the company the right to develop and market a drug. They'll only exercise that right if they believe the drug will be profitable enough to justify the enormous development costs. If not, They can let the patent gather dust. The patent is essentially a call option on the drug's future value. Or consider an undeveloped oil reserve owned by an energy company. The company has the right to drill and extract that oil. They'll only do so if oil prices are high enough to make it profitable. Until then, the reserve just sits there, patiently waiting. The reserve is a call option on oil. Traditional DCF valuation often completely misunderstands and undervalues these kinds of assets. Why? Because DCF tries to estimate expected cash flows, averaging out all the possibilities. But the very essence of an option is that you can avoid the bad outcomes. You simply don't exercise the option if it's going to lose you money. The value isn't just the present value of some average expected outcome. It's the value of having the choice, the flexibility, the ability to wait and see. And here's where it gets really interesting. The more uncertainty there is, the more valuable this choice becomes. This is a profound insight that flips conventional thinking on its head. In DCF valuation, uncertainty is the enemy. It increases the discount rate and crushes value. But in option valuation, uncertainty can actually be your friend. The more volatile oil prices are, for instance, the more valuable an undeveloped oil reserve becomes, because volatility increases the chances of a massive payoff. This approach is incredibly powerful for valuing assets that have embedded flexibility or strategic choices. It works for patents, natural resource reserves, or even the option a young company has to expand into new markets or pivot its business model in the future. So there we have it, 3 distinct paths. DCF valuation seeks intrinsic value based on fundamentals. Relative valuation hunts for mispricings by comparing assets to their peers. Contingent claim valuation captures the value of flexibility and strategic options. They're not mutually exclusive. They're different tools in your toolkit, and a skilled analyst knows which one to pull out for each situation. The rest of our journey is about mastering these tools in depth. We'll dig into the heart of DCF valuation. How do we actually measure risk? How do we estimate those all-important cash flows? How do we forecast growth without deceiving ourselves? These are the fundamental building blocks of value. Let's start with risk, because if you don't understand risk, you don't understand value. In finance, we define risk as the variance between actual returns and expected returns. If you invest in a government bond, you know pretty much exactly what return you'll get. It's essentially risk-free. But if you invest in a stock, the actual return could be wildly different from what you expected. It might be much higher, sending you off to celebrate with champagne, or much lower, sending you into a spiral of regret. That variance, that uncertainty, is risk. But here's the critical, game-changing insight that changed finance forever. Not all risk is rewarded by the market. We can break risk down into 2 types. The first is risk that's specific to a single company or a small group of companies. We call this firm-specific risk or unsystematic risk. Maybe a new product flops spectacularly. Maybe the CEO gets caught in a scandal. Maybe a factory burns down. This is obviously bad for that particular company, but here's the thing. As an investor, you can protect yourself from it completely. How? By not putting all your eggs in one basket. By diversifying. If you own 20 different stocks across different industries, a disaster at one company barely makes a dent in your overall portfolio. The good news and bad news from different companies tend to average out and cancel each other, like waves interfering with each other. The second type of risk affects all companies, or at least a large swath of them. We call this market risk or systematic risk. A spike in interest rates, a recession that crushes consumer spending, a war that disrupts supply chains. These are forces that drag down the entire market. You cannot diversify this risk away. No matter how many different stocks you own, they'll all suffer when the market crashes. Here's the punchline. Because investors can eliminate firm-specific risk essentially for free through diversification, the market doesn't reward you for taking it. It's like expecting a medal for climbing stairs when there's an elevator right next to you. The only risk the market will actually compensate you for bearing is market risk, the risk you cannot diversify away no matter how clever you are. This is the central revelation of modern portfolio theory, and it leads to a very important number that you've probably heard thrown around: beta. Beta measures a stock's market risk, its sensitivity to overall market movements. It tells you how much a stock tends to move when the broader market moves. A stock with a beta of 1 moves in lockstep with the market. When the market rises 10%, it rises 10%. A stock with a beta of 2 is twice as volatile. It's like the market on an emotional roller coaster. It goes up 20% when the market goes up 10%, but it also crashes 20% when the market drops 10%. A stock with a beta of 0.5 is more stable, like that calm friend who never seems rattled. The higher the beta, the more market risk you're taking on, and therefore the higher the return you should demand as compensation. This required return is what we call the cost of equity. It's the minimum return investors need to justify taking on that risk. Now let's tackle cash flows, because this is where the rubber really meets the road. We start with a company's accounting earnings, but we have to be extremely careful here. Accounting earnings are not the same as cash flows. Not even close sometimes. Accountants follow their own set of arcane rules, and their primary goal is not to measure the true cash-generating power of a business. They're concerned with matching revenues with expenses, with following standards, with keeping regulators happy. Our goal is fundamentally different. We need to adjust those accounting numbers to get to the real cash flow, the actual money that's either sitting in the bank or could be distributed to investors. We start with the after-tax operating income of the firm. Then we need to account for how much the company is plowing back into the business to fuel future growth. This reinvestment has 2 main components. First is net capital expenditures, which is money spent on long-term assets like new factories, equipment, or technology, minus the depreciation on existing assets. Second is investment in non-cash working capital, which is essentially the cash tied up in day-to-day operations, things like inventory sitting in warehouses and money customers owe you but haven't paid yet. A growing business has to invest in both of these areas. So the free cash flow to the firm is after-tax operating income minus net capital expenditures minus the investment in working capital. This is the cash available to all the stakeholders in the firm, both stockholders and bondholders, everyone with a claim. This is what we discount at the overall cost of capital, a weighted average of the cost of equity and the cost of debt, to arrive at the value of the entire business. To get to the value of just the equity, we simply subtract out the value of the debt. Simple in concept, challenging in execution. The final piece of this puzzle is growth. And this is where things get really interesting. Where does growth actually come from? Is it magic? Does it just materialize out of thin air? Because a charismatic CEO wills it into existence? No. A firm can only grow if it reinvests a portion of its earnings back into the business. The more a firm reinvests, and the more skillfully it deploys those reinvestments, the faster it can grow. The relationship is elegantly simple and powerful. Expected growth equals reinvestment rate times return on capital. The reinvestment rate is the percentage of after-tax operating income that gets plowed back into the business instead of being distributed to investors. The return on capital is the return the firm earns on those reinvestments. A company can grow by reinvesting more money or by earning higher returns on what it reinvests, or ideally both. But here's the absolutely crucial insight that many people miss. Growth by itself doesn't create value. You can have a company that's growing like crazy, expanding into new markets, opening new locations, but if it's earning a return on those investments that's lower than its cost of capital, that growth is actually destroying value. It's like digging holes and then filling them back in. Lots of activity, no progress. Growth only creates value when the return on capital exceeds the cost of capital. This is perhaps the most important lesson in the entire book. Think about it this way. If a company has a cost of capital of 10% and it invests $1 million in a project that only returns 5%, it has just destroyed value. The company would have been better off returning that money to shareholders. We're often mesmerized by high growth rates. We see them as universally positive. But the quality of that growth matters infinitely more than the quantity. Now, how long can a company realistically sustain high growth? Forever? Obviously not. As a firm grows larger, the law of large numbers inevitably kicks in. It's relatively easy for a $10 million company to double in size. That's just another $10 million. But for a $100 billion company to double? That requires finding another $100 billion in value, which is substantially harder than finding loose change in your couch cushions. Eventually, every company's growth rate slows down to a stable rate that it can maintain indefinitely. And this stable growth rate cannot exceed the growth rate of the overall economy, because if it did, the company would eventually become the entire economy, which is clearly impossible unless you're in a science fiction novel. This brings us to the complete picture of a DCF valuation. We forecast a company's cash flows for a period of high growth, typically 5 to 10 years, depending on the company and industry. Then we estimate something called a terminal value, which represents the value of the company at the end of that high growth period, assuming it settles into stable, sustainable growth forever after. The value of the company today is the present value of the cash flows during that high growth period, plus the present value of the terminal value. It's essentially a two-stage process, and it captures the entire life cycle of a business, the exciting adolescence and the mature adulthood, in a single valuation framework. And so the quest for value comes full circle. It's not about discovering some secret formula or magic number that unlocks unlimited wealth. It's about crafting a story. A disciplined, internally consistent story about a company's future, grounded in realistic expectations about cash flows, growth prospects, and risks. The numbers are just the language we use to tell that story. The real art, the real skill, is in crafting a narrative that's both compelling and honest. So what have we actually learned on this journey through the world of valuation? What's the ultimate takeaway from this masterclass? For me, it comes down to this. Valuation provides a framework for disciplined thinking in a world that constantly rewards and encourages undisciplined thinking. It forces you to separate the compelling story from the underlying substance, the exciting hype from the boring reality, the narrative from the numbers. In a world that's perpetually screaming at you to buy this hot stock or sell that declining industry, to chase the latest trend, or flee from the latest crisis, valuation is that quiet, steady voice of reason calmly asking, but what is it actually worth? The most powerful lesson embedded in this book is the relentless focus on the connection between growth and value creation. We live in a culture absolutely obsessed with growth. We celebrate high-growth companies, we put their CEOs on magazine covers, and we reward executives handsomely for delivering growth. But as we've discovered, growth is a double-edged sword. It can cut both ways. Growth that costs more than it's worth. Growth where the return on investment falls short of the cost of capital actually makes you poorer. It's like trying to fill a bucket that has a massive hole in the bottom. You can keep pouring in more water, working harder and harder, but you'll never fill it up. Value is created only when a company invests in projects that earn returns exceeding the risk-adjusted hurdle rate. That's the iron law of corporate finance, and it cannot be bent, broken, or negotiated with. So how can you, as someone trying to navigate your own life and career, apply this wisdom beyond just picking stocks? First, start thinking of every major decision you make as an investment decision. Whether you're choosing a college, selecting a career path, deciding to start a business, or even entering a relationship, you're investing your most precious, irreplaceable resource, your time. Ask yourself the hard questions. What are the expected returns from this decision, not just in monetary terms, but in happiness, personal growth, fulfillment, and learning? What's the risk? What could go wrong? And what return do I need to justify taking on that risk? This kind of thinking cuts through emotional fog and brings remarkable clarity to life's most important choices. Second, become a student of value, not just price. In your career, resist the temptation to simply chase the highest salary or the most prestigious title. Instead, look for opportunities that allow you to grow your skills, learn from exceptional people, and build what economists call human capital, the skills and knowledge that compound over time. These are the investments that generate the highest long-term returns, even if they don't look as impressive on paper in year one. Third, always remember the critical difference between a good company and a good investment. A fantastic company with an amazing product, loyal customers, and talented management can be a terrible investment if you pay too much for it. And conversely, a mediocre company that everyone has written off and forgotten about can be a wonderful investment if the price is low enough and there's a realistic path to improvement. This distinction is what separates successful investors from everyone else. That was a summary of Investment Valuation by Aswath Damodaran. We've explored the highlights today, the key concepts and frameworks, but I'll level with you. A summary can only take you so far. It's like looking at a map of a beautiful hiking trail versus actually walking it yourself. The real magic happens when you engage with the book directly, when you work through the examples, when you pause to think about a particular insight that resonates with your own experience. This overview is designed to give you a roadmap to help you decide if this is a journey worth taking. If anything we've talked about today has sparked your curiosity or challenged your thinking, I strongly encourage you to pick up a copy and dive in. Reading it isn't just about memorizing formulas or techniques. It's an experience that can fundamentally transform the way you see the business world and your place in it. You'll find a link to the book in the description below. Also, if you found value in this exploration, please show your support by liking this video and subscribing to the channel. That way, you'll be notified when we dive into our next adventure through another transformative book from the Billionaire's Bookshelf. Let's continue learning and growing together, one book at a time.